Have you ever wondered why the price of your favorite coffee or the rent for your apartment seems to be constantly rising? Well, let's take a step back and examine the economic landscape we're currently navigating. First up, let's talk about unemployment. The American job market has been on a roller coaster ride for the past few years. With the shock of the pandemic, we've seen the unemployment rate skyrocket, then gradually decline as businesses reopened. However, it's still not back to the pre-pandemic levels. This means that a significant number of Americans are still out of work, and that's a huge concern. Now let's shift our focus to GDP growth. Gross domestic product, or GDP, measures the value of all goods and services produced within a country. It's like a health checkup for the economy. And right now, the American economy is showing a steady increase in GDP, indicating a recovery from the recent downturn. But remember, it's not just about growth, but also the quality and sustainability of that growth. Next, let's talk about consumer spending. This is where you and I come in. Every time we buy a cup of coffee, a new pair of shoes, or even pay our rent, we're contributing to the economy. Consumer spending is a major driving force in the American economy, accounting for about 2/3 of GDP. Lately, we've been seeing a rise in consumer spending, which is a good sign. But here's the catch. The prices of goods and services have also been rising. And that brings us to the concept of inflation. Simply put, inflation is a continuous rise in the prices of goods and services. It's like a slow-motion movie where the cost of your daily coffee gradually increases, or the tag on that pair of shoes you've been eyeing keeps creeping up. This is what we call inflation. But what exactly causes it, and how does it affect our economy? Well, to answer that, we'll need to delve a bit deeper. So stick around as we unravel the mysteries of inflation in our upcoming scenes. Inflation, in simple terms, is when the average price of goods and services increases over time. Imagine going to your local grocery store and noticing that the loaf of bread you always buy has gone up in price. That's inflation at work, right there in your shopping cart. Now let's break it down a bit more. Inflation is measured by the Consumer Price Index, or CPI, which looks at a basket of goods and services and tracks how their prices change over time. This basket might include everything from a gallon of milk and a dozen eggs to a haircut or a movie ticket. If the overall cost of these items goes up, then we're experiencing inflation. The Federal Reserve plays a critical role in controlling inflation. You see, their goal isn't to eliminate inflation entirely, but rather to keep it at a manageable level. Why is that, you might wonder? Well, a little inflation can actually be a good thing. It can encourage spending and investment, which can stimulate economic growth. If prices are expected to rise in the future, consumers might decide to make purchases sooner, and businesses might choose to invest in new projects. But if inflation gets too high, or if it becomes too unpredictable, that's when we run into problems. High inflation can erode purchasing power, meaning your hard-earned dollars don't stretch as far. And if inflation is unpredictable, it can create uncertainty, which can lead to less spending and investment. So you see, the Federal Reserve has quite the balancing act on its hands. It's like trying to walk a tightrope. They need to keep inflation low enough to maintain purchasing power, but not so low that it discourages spending and investment. Inflation, therefore, is not just about higher prices. It's a complex economic phenomenon that affects everything from our grocery bills to our national economy. And while it can be a challenge to manage, it's also a vital part of our economic landscape. Inflation is not necessarily a bad thing, but it can become a problem when it is too high or too unpredictable. So, what exactly causes inflation, you might ask? Well, it's typically the result of three main factors: demand pull inflation, cost push inflation, and built-in inflation. Let's break these down one by one, shall we? First up, demand pull inflation. This is when demand for goods and services exceeds their supply. Imagine a hot new gadget hits the market, and everyone wants to get their hands on it. The manufacturer simply can't produce enough to meet the demand. As a result, they might raise the price. This is demand pull inflation in action. Next, we have cost push inflation. This happens when the costs of production increase, causing producers to raise prices to maintain their profit margins. For example, if the price of oil goes up, it costs more to transport goods. This extra cost is often passed on to the consumer in the form of higher prices. That's cost push inflation for you. Finally, there's built-in inflation. This is inflation that comes from the expectation of future inflation. If people expect prices to go up in the future, they might ask for higher wages or charge more for their services now. This can create a self-fulfilling prophecy where the expectation of inflation leads to actual inflation. Now, it's important to note that these types of inflation can occur simultaneously and often feed off each other. For instance, a rise in demand could lead to higher production costs, which in turn could lead to cost-push inflation. Similarly, the expectation of future inflation could lead to demand-pull inflation as people rush to buy goods now before prices go up. It's also worth noting that central banks, like the Federal Reserve in the United States, play a crucial role in managing inflation. They can adjust interest rates and control the money supply to try and keep inflation at a manageable level. Understanding these causes is key to understanding why the prices of goods and services continue to rise. Stay tuned as we delve deeper into the impact of inflation on the American economy in our next segment. Now that we understand what causes inflation, let's examine its impact on our economy. Inflation, in essence, is a rise in the general price level of goods and services over a period of time. This increase in prices affects the economy in several ways, both positively and negatively. Firstly, let's discuss the negative impact. One of the most felt effects of inflation is the erosion of purchasing power. As prices rise, each dollar you hold buys a smaller percentage of a good or service. If wages don't keep up with inflation, the standard of living could decline. The uncertainty of future inflation can cause businesses to delay investment and hiring, which can lead to slower economic growth. Another consequence is how inflation interacts with interest rates. When inflation is high, lenders demand higher interest rates as compensation for the decrease in purchasing power of the money they'll be repaid in the future. This can lead to less lending and investing, which can further slow economic growth. Now, on the other side of the coin, inflation can also have positive effects on the economy. Moderate inflation can stimulate economic growth. When people expect prices to rise in the future, they're more likely to buy goods and services now, boosting current economic activity. Similarly, businesses may increase production and hire more workers to meet this increased demand. Inflation also allows for nominal wage increases without reducing employment. If a company needs to cut costs, it can simply freeze wages. Over time, inflation will make these wages effectively smaller, which can help the company's bottom line without laying off workers. Inflation can also help reduce the real burden of debt. If you borrow money, inflation means that you'll repay that debt with dollars that are worth less than when you borrowed them. This can be beneficial for borrowers, but detrimental for lenders. As we can see, inflation is a double-edged sword. It can stimulate economic growth, but it can also lead to economic instability if not managed properly. So, will the American economy ever recover from high inflation? The answer, while not simple, is optimistic. To understand it, we need to look at the bigger picture. The American economy, like all economies, is a dynamic entity, always shifting and changing. Inflation, though often viewed negatively, is a natural part of this dynamism. It's the speed of inflation that can be cause for concern. When inflation rates skyrocket, it can lead to economic instability. But remember, economies are not static. They are constantly evolving and adapting, and the American economy is no exception. The same mechanisms that can lead to high inflation can also be harnessed to manage and control it. Monetary policy plays a key role here. The Federal Reserve can adjust interest rates, influencing the amount of money circulating in the economy. Lower interest rates can stimulate economic growth, but they can also lead to inflation. On the flip side, higher interest rates can curb inflation, but might slow down economic growth. It's a delicate balancing act. Fiscal policy controlled by the government is another powerful tool. By adjusting tax rates and government spending, the government can influence the overall demand in the economy. Reduced spending or increased taxes can slow down an overheated economy and combat inflation. However, these strategies are not without their challenges. They require careful planning and execution, as well as a keen understanding of the economy's current state and future trajectory. Moreover, the future of the American economy isn't just about managing inflation. It's about fostering sustainable growth, creating jobs, and improving living standards for all Americans. It's about investing in infrastructure, technology, education, and healthcare. It's about building an economy that is resilient, inclusive, and forward-looking. While the future is uncertain, understanding the causes and effects of inflation can help us better navigate the complexities of the economy. And so, as we venture into the future, armed with knowledge and understanding, we can face economic challenges head-on, shaping an American economy that is strong, vibrant, and prosperous.